In today's video, I am going to be comparing ZSP and ZUE. These are two very similar ETFs with one slight difference. So let's get down and let's check them out and see which one's better for your portfolio. Okay, so what is the difference between ZSP as well as ZUE? Well, basically what ZSP does is it's an index fund for the S&P 500, which is the American stock market, or at least one of the American stock markets. It's basically designed for investors looking for growth solutions. As we know, the S&P 500 goes up generally around 8% per year, so that's pretty good. That's a lot higher than inflation. And of course, exposure to the US stock market. Its management fee is 0.09%. So it's really not that expensive when it comes down to it. It does pay a dividend every quarter, and generally speaking, it does get higher every single year. And the current average market volume is around 705,000 shares being traded every single day, so it's very easy to get in and out of this ETF. Its dividend is also 1.17%. Meanwhile, ZUE is a hedged S&P 500 ETF. What does that mean? Well, let me just break down this really quickly. So I made a really handy chart in another video that I just recently recorded, and it really does explain it quite well. So basically, hedged versus non-hedged. What is the real difference between these two types of ETFs? Well, basically, a hedged ETF is going to allow you to make safer bets. That is essentially what it is. So going down the whole list here, what you're looking at is with a hedged ETF, the best outcome you can have is exactly what the stock market does for you. However, with a non-hedged ETF, you are now playing also the currency game, which can be a lot more riskier, as we can see here. Because if the host country's currency goes up while the market goes down, then you ultimately get zero, roughly. And then if the currency goes down by 10%, but the market goes up by 10%, then in theory, it's roughly zero once again for you if you're in a non-hedged. Meanwhile, with a hedged, you would have been down roughly 10%, or you would have been up roughly 10%. Basically, a hedged ETF is going to mirror exactly what the stock market does. Meanwhile, with a non-hedged ETF, if both host currency goes down as well as market goes down by 10%, you'll be down well over 20%. Meanwhile, the hedged account will only be down about 10%. So overall, a hedged ZUE is a safer bet than ZSP, especially if you're looking for future growth. However, if you feel like your host currency, the host country's currency, is going to go up versus your home currency, for me would be Canadian dollar. If the Canadian dollar goes up and the host currency goes down, that would mean that it would be negative for me to go for a non-hedged. So right now, the Canadian economy, for a while anyways, was starting to get really good versus the Americans, and that's why the Canadian currency has been slowly increasing. However, right now, I think that our economy isn't all that great, and I think that the US economy is going to be doing much better than Canada. This is my own personal opinion. So, by investing in ZSP right now, that may be a better choice. However, it's never guaranteed. There's more risk with non-hedged than there is with hedged. Meanwhile, the distribution is 0.05% lower with the hedged versus the non-hedged. The management expense ratio is the exact same. However, market volume is a lot less at around 24,000 shares traded per day. Now, why is that important? Well, the reason why this is important is because now, if you're looking at buying 5, 10, 15, 20,000 shares, then at that point, this may be not very liquid for you to get into. However, there's also still only about 27 million shares outstanding, so at the same time, you still should be able to get in and out of it fairly easily. It also does pay the dividend quarterly as well. Now, when it comes to the distribution, both ZUE and ZSP are 18 cents each per quarter per share. And technically, they both hold the exact same amount of companies. Technically. Let me explain. So when it comes to percentages, this is what ZSP is holding. It's holding Apple, Microsoft, Amazon, Facebook, Google, Berkshire Hathaway, Tesla, absolutely amazing company, Nvidia, and Johnson & Johnson. Meanwhile, ZUE is going to be holding BMO, S&P 500, ZSP. Now you're probably wondering, well, if it just holds that, then what's the difference? Well, actually, about 2.7% of it is going to be hedged. And that is the hedged currency, and basically you can play this game yourself. It's probably not easy, and I personally don't do it. However, when it comes to a hedge, they are basically using cash as an advance to essentially play almost like the futures game with currency, so that they are always never worrying about the currency fluctuations of the stock market, of ZSP, and instead basically playing futures so that they can get the future price, potentially, of course, the currency. And that's how they're playing it. It's not very easy to explain when it comes to this. However, all you really need to know when it comes down to it is it's hedged, and you're not going to have to worry about currency. You're just going to have to worry about the underlying stock market value. And we can see this right here. So in the non-hedged over the past 5 years, it's gone from $31 to $61, which is about a 96% roughly increase in the stock price of the ETF price. Meanwhile, 5 years ago, we can see that it was around $37, and it's currently sitting at $64, which makes the hedged ETF an increase of 73 roughly percent. So we can see over this 5-year period that the hedged ETF has underperformed the non-hedged. What that ultimately means is over that time, the Canadian currency has devalued versus the American. The American dollar has gone up over that 5-year period. And then on top of it, the stock markets also increased during that time, which means that ZSP over the past 5 years should have and has outperformed the hedge. Which means that over the past 5 years, ZSP versus ZUE was a better decision. Now, when we start looking at our two economies and we start looking at our two currencies, now when we have to really look at it is the stock market is separate from the economy. We have to try and remember that. It's not supposed to be like that in theory, but it is. When it comes to the currency, that is what is hedged, or that is what is comparable to the actual underlying economy. And because of that, we can see what's going to happen potentially in the future. And if we really do look at the currencies, do we think that the Canadian economy is going to outpace the American economy? Personally, I don't think so. There's a lot of new tech that is happening in the United States, and we're not getting that up here in Canada. We are still trying to build pipelines, and it's just not happening. We are still focused more on oil up here than we are with new technology as the Americans are. And because of that, I personally think that the Canadian economy is not going to outpace the American economy. So because of that, I think that ZUE is going to be potentially the worst investment out of the two of them over the next, let's say, 5 years. I could be wrong. We have to make decisions for ourselves. So my suggestion to you is if before you invest in these two different ETFs, you could go 50-50 in each. That's totally okay. I'm not saying you can't do that. However, do the research yourself. Look into what you think the future economy looks like in both of these countries, and then at that time, invest accordingly to what you personally feel between the two economies. ZUE is betting more on the Canadian side because, of course, even though it's covering the S&P 500 in the States, ZUE is hedged, which means that it's hedged to your dollar, getting the exact same outcome as what the stock market does in the States. Meanwhile, with ZSP, you're going to be looking at the currency plus the stock market. I hope that this really helps you. If it does, hit that like button, subscribe. Make sure to do your own research. Never trust a random YouTuber on YouTube, and I'll see you guys again next time.